On February 28, 2026, a single blog post shook Wall Street to its core. It was titled, "The 2028 Global Intelligence Crisis," published on Substack by a small research group called Treasury Research. Within just 24 hours, the Dow Jones plunged 820 points. IBM stock crashed 13%. Visa and MasterCard each dropped more than 8%. Blackstone, Uber, DoorDash, American Express all fell sharply. And this wasn't triggered by a central bank decision, or a bad earnings report, or even a note from Goldman Sachs. It came from a self-described thought experiment, written as if looking back from the year 2028 is describing an economic collapse that hadn't even happened yet. Yet markets reacted like it was already real. Why? Because in the age of AI, narrative isn't just commentary, it's a force that moves markets. And here's the unsettling truth. AI's biggest danger may not be that it fails, but that it succeeds too well. Let's break this down. First, the ghost GDP problem. AI boosts productivity. Corporate profits hit record highs in late 2025. But consumer spending on travel, dining, entertainment, it's been falling for 3 straight quarters. Why? Because machines don't spend money, they don't book hotels, they don't renew insurance, they don't swipe credit cards, they optimize, they don't participate. So we get glowing GDP numbers, while the real economy quietly hollows out. This isn't theory. Just days before the market crash, Anthropic demoed an AI that rewrites old banking code in minutes. That code runs on IBM mainframes, a $30 billion a year business. No wonder IBM shares collapsed. Second, the end of friction-based business. Citrini argues that soon, your personal AI agent will do everything for you. Book flights, compare insurance, file taxes, negotiate bills, and it won't care about brand loyalty or slick ads. As they put it, much of what we call relationships are just friction, wearing a friendly mask. McKinsey estimates that 48% of white-collar tasks in the US can now be automated. These are high-income jobs, legal assistants, financial analysts, customer support leads, and together they drive 73% of all non-essential consumer spending. When AI removes the hassle tax, entire industries lose their reason to exist. Third, the white-collar recession. U.S. labor data shows something alarming. While tech jobs grew 12% in early 2026, roles like insurance underwriters and accounting clerks shrank by 9.3%. The first net decline in this group since the Great Recession. Displaced professionals flood gig apps, Uber, DoorDash, pushing wages down for everyone. Even those still employed start saving more, spending less, out of fear. And that kills demand at the very top of the income ladder. Fourth, a hidden financial time bomb. Few realize how exposed retirement funds are to AI risk. S&P Global reports the default rates on SaaS company loans in private credit markets hit 4.7% in late 2025, double the rate just 2 years ago. Why? Because companies are canceling Salesforce and Workdays and replacing them with custom AI agents that cost pennies. Now here's the scary part. 22% of collateral in U.S. private credit funds is tied to these digital service firms. And those funds sit inside your 401k, your child's college endowment, your pension. Fifth, and this is critical, AI is no longer just an economic story, it's a military one. In February 2026, Israel struck Iran's Natanz nuclear site using an AI battle system called Fireweaver. It fused drone, satellite, and signals data and assigned weapons to targets in just 17 seconds. 20 times faster than humans. Iran responded with its own AI, Zamzam-3, which simulated U.S. military responses so accurately that CENTCOM delayed F-35 deployments. Meanwhile, DARPA is testing AI diplomatic agents that simulate how foreign leaders think under pressure. AI isn't just changing markets, it's reshaping war and diplomacy. So why did one blog post move billions? MIT Sloan found that AI-related narratives cause over 3 times more market volatility than other sectors. Because when the future is uncertain, investors don't wait for data, they follow stories. Citrini's piece worked because it was simple. scary, and specific. It named companies. It explained mechanisms. It made the abstract feel inevitable. And George Soros's idea of reflexivity took over. Belief led to selling. Selling caused prices to drop, which made the story seem true, which triggered more selling. The narrative created the reality. Finally, there's a growing gap between nations. The US is still debating AI regulation in Congress, but the UK just launched a £2 billion AI transition fund to help small businesses adopt human AI teams. Result? The UK saw 21% growth in AI-augmented jobs last year, the US just 9%. In the AI era, agility beats technology alone. So where does this leave us? Full economic collapse by 2028? Unlikely. Technology adoption is slower than hype suggests, but the trend is clear. AI will disrupt white-collar work. It will erode legacy business models. It will strain financial systems, and it's already changing warfare. The real question isn't whether this happens, it's how we respond. If we believe AI means doom, we'll cut, hoard, and retreat, making collapse self-fulfilling. But if we treat AI as a tool to amplify human creativity, judgment, and care, we can build something better. Because in the end, narratives don't just describe the future, they create it. Don't panic, don't ignore, engage. In an age where story shapes reality, your mindset is your most powerful asset.